Don't sell your assets in the event of a crash and revert to cash. This is possibly the worst strategy you can do. Property in your SMSF is a great strategy that a lot of our clients use to create wealth, and also the ability to have leverage inside your fund as well. What I mean by that is if you want to purchase property, you don't need to pay cash. You can actually borrow using your SMSF. Industry fund versus SMSF in an economic downturn. Which one is going to fare better? Well, the answer is welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services. And over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Hi guys, and welcome back to episode 2, where we will be touching on your investment portfolio and how that may be affected in the event of a downturn. Talking a little bit about diversification, over-diversification, and under-diversification, and how having advice can help making sure you've got the right asset allocation. So let's jump right in. Will your SMSF survive the next downturn? What does a collapse actually look like? Well, in a recession, asset prices typically reduce in value. So Australian shares, international shares, property in some sectors will also reduce in value. So what can you do to protect your portfolio in the event of this happening? The answer is mostly defensive assets, and cash obviously being king. If you're in cash, that gives you the ability to then purchase some of these assets at reduced pricing. So when the international pricing crashes or shares crash or Australian share prices crash, having cash gives you the ability to then purchase these assets at a discount. It's like buying a pair of shoes or a pair of jeans on sale. It's no different when you're talking about asset prices. So it's the perfect time to be buying assets is when it crashes. Don't be scared about jumping in. Although it will feel like the world is ending because the media will make it feel like it is, but that is the best time to be purchasing assets is during a crash. So don't have all your eggs in one basket if you can avoid it. Have some diversification and make sure you're keeping cash. An example of having all your eggs in one basket might be having your fund invested in one particular stock or in one particular asset, or all in international assets or equities, all in Australian equities. Diversification is a simple term for having a spread. So having a little bit of everything is always a good idea when you're investing. And that could mean anything from Australian shares, international shares, property, fixed interest, and of course cash. When we talk about property, obviously there's different subsectors of the property market. So there's residential, there's commercial, industrial. If you are heading in this space, you need to decide which part of this subsector is right for you, whether it's resi, commercial, or industrial. Stay aware of what's happening in the market in general. That's always a good idea when you are invested, because it gives you the chance to not predict, but it keeps you involved and keeps you more engaged with your investments and your SMSF specifically. At the time of a crash, it's going to feel like the world is ending and that it's going to last forever, basically. The media is going to make things sound a lot worse than they are. But when you go back and have a look at crashes over the last 50 years, those crashes typically only last around 18 months. Sometimes more, sometimes less, but it's going to feel like forever. And the key to the crash is going to be stay your course. Don't jump into cash because you'll miss the bounce, and stay invested. And that all comes down to your psychology when you're investing, and making sure you're prepared in the event of a downturn. Property in your SMSF. So having property in your SMSF is a great strategy that a lot of our clients use to create wealth, and that can be anything from residential property, commercial, or industrial property. The reason it does so well, this particular strategy, is most of those strategies have gearing or have a loan involved, which gives the fund more leverage. So you've got more money working for you as opposed to the 300,000, for example, that you initially put in. So instead of getting returns or 7 or 8 or 9% on 300,000 or 400,000, you're now getting those returns on 800, 900 or $1 million. So that compounded over the long term can make a huge difference to your end game. Property over 3 million is about to be taxed, whether you've sold those assets or not, and that's called Division 296. Pretty hot topic at the moment. And what that is the ATO collecting money off SMSFs or super funds in general that have more than 3 million in their super fund. Now, it doesn't matter whether you've sold those assets or not, the government or the ATO is going to take that money from you or going to put their hand out for that money regardless of where that money is invested. Whether you've got that money or not, you will owe that money and you will need to pay it. Although it's 3 million and it might seem like that's not going to affect you at the moment, and maybe it doesn't, but as time goes on, that 3 million isn't indexed. So what that means is that as time goes on and you will eventually have 3 million, hopefully. But certainly the younger generation, as time goes on, that will come through and everyone will be paying Division 296. So although it's not affecting a huge percentage of the population at the moment, as time goes on, it will affect a huge majority moving forward. An example of this, of how Division 296 is going to affect assets over 3 million is a prime example of this might be a farmer that has put his farm in his SMSF that is now worth a lot more than 3 million. Where does that money come from? A lot of these farmers depend on rainfall and some of these circumstances are outside of their control. Weather is certainly being the main one. So where does this money come from if the farmer doesn't sell his cattle or doesn't sell his stock? Where does this money come from? Well, no one really knows at this point, and it doesn't seem like anyone really cares as long as the money is paid. Not a great way to look after some of our old retirees that have worked their whole life and paid their whole taxes. Doesn't seem fair, but it's a huge disincentive for people to continue to grow their wealth inside of super. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes and let's build your future on your terms. Now, back to the episode. Although the Division 296 is set or about to be, the bill is for, the benchmark is 3 million. The Greens do want this lowered to 2 million, which will affect obviously a lot more people. So the legislation has yet to be passed, but it's going to be, my understanding is there is going to be a challenge, a constitutional challenge. So everyone is looking in this space to see what happens next. Back in 2007, the government had an incentive to contribute, sell your home and invest that money into your super fund. So those that did that, sold their home, their family home, invested that into super, and then maxed out their contributions every year. So those people that were doing as they were supposed to do or as they were allowed to do are now sitting on, portfolios of around $3 million. And all these guys are going to be taxed on assets that they haven't even sold yet. So in 2007, the Howard government gave everyone an incentive to contribute more money to super. Contribute up to $1 million into super. If you had invested that $1 million into super and then maxed out your concessional and non-concessional contributions, you could easily have $3 million in super at the moment. Now they've turned around, the current government, and are going to tax all of these older clients that have worked their whole life, made contributions, sacrificed their family home and sold it to contribute to super, and now they're being taxed on assets they haven't even sold yet. I think this is a very unfair tax, as do most people. The issue is that what is next? What assets they're going to come for next? Is it family trust? Is it unit trust? Is it all assets outside of super? Is it the family home? Who knows? Time will tell. But at this point in time, I don't know anyone that's thinking this tax is a great idea. A well-structured SMSF can thrive during a collapse if it has enough cash and defensive assets. So things like, when I say defensive assets, things like gold, fixed interest, property, these are more defensive assets that can be sold during a downturn to dollar cost average and buy more of their growth assets like shares, Australian shares and international shares. Probably not so much property, but certainly cash. These are going to be your savior in the event of a crash. These are the things that are going to help you get through a crash, and these are the things this is the asset that's going to help you buy more of your growth assets while they're on sale. Nobody rings a bell and says there's about to be a crash, or no one rings a bell and says we're at the bottom, now's the time to buy. But having cash in your SMSF or in your overall investment strategy is going to help you when the crash eventually happens. As I said, no one really knows when that's going to be. No one rings a bell. So stay prepared, have cash available, and be ready to pounce. Industry fund versus SMSF in an economic downturn. Which one is going to fare better? Well, the answer is it depends where your money is invested. If you're invested in cash, then, which no one really is, then you're going to do well. But if most industry funds, you're in a conservative, balanced, growth or high growth fund, it's very rarely you see a mixture of these portfolios. So those portfolios are going to be affected, especially the high growth funds are going to be affected more than the conservative portfolios. With an SMSF, it's the same thing. It depends where you're invested. Most SMSFs will have liquidity or should be holding liquidity, should be holding cash. So your ability to purchase more and dollar cost average potentially is higher because you are holding a little bit more in cash, typically with an SMSF, or should be. So in the event of a downturn, an SMSF should realistically do better than an industry fund. So what not to do in a crash? Don't sell your assets in the event of a crash and revert to cash. This is possibly the worst strategy you can do. When the market has crashed, it's too late to be reverting to cash. You need to stay your course and you need to stay committed to your overall investment strategy. If you do revert to cash in an economic crisis, what will happen is you're sitting on cash, being fearful that you're going to lose everything. We've seen it time and time again. What happens is the market recovers. The client is still in cash. All of those gains the market is back to where it was before it crashed, and you're still sitting in cash. So you've actually missed the bounce. Now you're going to have to wait longer for your portfolio to recover. So being in cash is okay if you're in cash before it crashed, but if you revert to cash during the crash, you're in for a very long recovery. So when you are investing in overseas markets, you do have what's called currency risk. We have seen the Australian dollar fall against some of the major currencies. Probably not a great time to be hedging. Probably should have been hedged before this, but no one saw it coming. No one saw the tariffs coming. So it's very hard to predict some of these things. But when you are invested in overseas markets, you do have currency risk. After the currency has fallen against the country you invested in, probably, as I mentioned, it's probably too late to be starting to hedge. Probably want to stay unhedged, but it is something to be mindful of. If you are investing in overseas markets, you do have currency risk, and it's definitely something to be mindful of. So when we talk about diversification, we talk about not having all your eggs in one basket. So having a range of different asset classes in your portfolio. It's important to get advice around this, but it's also important not to be over-diversified. So don't be under-diversified, don't be over-diversified. So it is important to get advice when you're talking about diversification and not having all your eggs in one basket. So at the moment, there is a massive property or housing crisis. So there is looking like a continual upward pressure in housing prices. It's been ongoing for as long as I can remember. This housing affordability has been a hot topic since I started investing 20 years ago. So nothing's changed since then. Vacancy rates are super low, rents are high. There is a housing shortfall. So long term, it does look like, property does have a pretty good future for at least the medium term, as far as we can see. But interest rates are finished their upward cycle and are cycling down now, even though there are being, the RBA are watching inflation very closely. But with rates coming down, it is going to to spur the market on and get people excited about jumping back into the property market. We've seen clearance rates already start to jump in every major capital city, with growth in every major capital city last quarter. So I think that space does look quite positive, and so having some exposure in there is not a bad idea. With rates coming down and property prices continuing to rise, vacancy rates low, and also the ability to have leverage inside your fund as well, just gives you that ability to purchase some of these assets. So what I mean by that is you don't need to pay cash if you want to purchase property. You don't need to pay cash. You can actually borrow using your SMSF, using what's called a limited recourse borrowing arrangement, which is a fancy name for a loan. Obviously, seek advice before making any investment decisions. When is the right time to invest? Well, yesterday is typically the right time to invest. It's time in the market, not timing the market, waiting for a downturn. So the longer you're invested, the better off you're going to be. And that applies to shares, it applies to property, it applies to almost every single asset class. So it's important that you get invested as soon as you possibly can and not sit around waiting for a crash. When the crash happens, maybe have some cash to deploy to purchase more of that asset. But certainly don't wait around for a crash. It's time in the market, not timing the market. So that's a really important one. So that's a wrap, guys. Thanks for listening. If you've got any comments or there's something you'd like us to talk about, feel free to drop a comment or in the comment section below, and look forward to catching up on the next episode of SMSF Insider. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.